Taxes and fees, a special lecture. No citizen, no business enjoys taxes or fees. In fact, many people think of it as a government shakedown. Somehow or another, government just takes money right out of our pockets. Let's look at the next few things we'll be talking about as we move ahead. First, what are the aims of taxes and fees? What is the difference? How do we define taxes, fees, and excises? What do we mean by direct or indirect collection of taxes, fees, and excises? How are progressive, regressive, proportional, and digressive systems different? How do they affect ordinary taxpayers? Why are marginal and effective rates different, and why is that important? What are some common misinterpretations and misunderstandings on these things that we've just talked about? And finally, outside of this lecture, there will be a quiz. So it's important to understand that this is a very general introduction to the topic of taxes and fees. Every country, every state, even many different jurisdictions have different tax interpretations, different rules, different laws. Even in the United States, we've got 50 states, plus the US federal law, and also local taxes. And they're all different. So the ordinary taxpayer could be paying federal taxes plus state taxes, plus, in some cases, local taxes. And where you live, each will be different. Federal taxes also sometimes apply on strictly federal property, like a military base, where there is no state or local tax. So why do we have taxes and fees? What are the objectives? What are we trying to accomplish? And when we look at each individual, particular, unique tax or fee, what's the objective of that tax or fee? These can vary wildly. As you might expect, the most common answer for why there are taxes or fees is to make money for the government. General purpose revenues and specific purpose revenues. At the same time, taxes may be used to encourage or discourage behavior. Thirdly, taxes and fees are sometimes used to promote equity. Let's consider these three main points individually. Number one, to generate revenue. Government needs money. Government uses money to accomplish public good. Of course, government can print money, but the most of the government money comes from taxes, fees, and excises. Government revenue is of two types. General purpose revenue, which, as you can understand, can be used for any type of purpose. It's unrestricted. And specific purpose revenues, where the tax is collected for a particular reason. Very often the law that allows the tax specifies how the money may be used. So we can think about things like the military is funded under general purpose revenues. Education, elementary school, middle school, could be general purpose, or there could be specific purpose revenues. Roads, public health, pensions for the aged, debt repayments. Debt repayments could be general purpose revenues when the city undertakes a general debt for a general good, or debt payments could be specific. For example, a city wants to build a new sports stadium. They have to borrow money to do this. Then they create a tax to collect money for the purpose of paying back the stadium debt. Second, to discourage specific behavior. This picture probably speaks for itself. Third, to promote equity. Equity? What is equity? What's the difference between equality and equity? Let's look at it this way. Equality looks at present condition. How are things now? And equity looks at what things should be. How can we make things fair? This picture probably explains better than I can. For equality, we give everybody the same thing. The tall kid, the middle kid, the short kid, they all get a box. But for equity, we're concerned with the end point. We want everyone to have the same view of the baseball game. So the tall kid doesn't need a box. The middle kid just needs one, and the short kid needs 2 boxes to be able to see the game. So some people would say giving the small kid, giving the less advantaged person more creates equity. So how much equity should we give? Well, there's several ways to look at the question. One way to look at this is to say, is there a big difference between people? I'm not going to talk in this class a lot about Gini coefficient. The simple way to describe it is to say that it's a measurement to see how much a small group of people owns. So a Gini coefficient might say that 2% of society own 20% of the valuable products. the assets, the land, the money. Another Gini coefficient might say that it's almost perfectly balanced. Almost everybody owns an equal share of the valuables in that land. Another way to look at equity is to think that some people feel like the rich are too rich, that the top 5% own 50% of all the valuables, and that's not right because they have too much. Kind of the opposite is a concern that the poor are just too poor. Maybe the middle class is okay. Maybe the rich have a lot. But my concern is that the poor are just too poor. These questions, however, raise a new question. If we disadvantage the rich, if we disadvantage the working class, if we take away from people what they have earned or gotten, are we also removing the incentive to work hard? Someone could say, there's no reason for me to work hard because whatever I get, I can't keep. The government's just going to take it anyway. So I don't need to work hard. And then again, the opposite, kind of opposite, is the concern that we need some kind of safety net, that nobody should get so poor or so disadvantaged that they can't take care of themselves. If you can't work because of injury, we'll give you money. If you're too old to work and you have no money, we'll give you money. Things like that. Nobody should be too low. We'll have a safety net to catch you so you don't fall too low. We can also talk about socialist perspectives. Here I'm not talking about politics, but about the economic concern that people should be kind of equal. People should have roughly the same amount of assets, money, housing, the things that we can own. And if somebody falls a little low, then we will help raise them up. And if somebody has too much, well, we'll kind of take it away from them. Maybe with a very, very heavy tax. And so we find some rich and famous people, tennis players who leave Sweden, rock and roll musicians who leave the UK, because the tax rate for the very wealthy is quite high. So they move to another country that doesn't tax so much. So now, let's get to the heart of it. What's the difference? Taxes, fees, excises. Taxes are paid for government services that are for everyone. We all benefit. Directly or indirectly, we all benefit. Schools? Well, what about the couple who say, we don't have any children, we're not sending any children to school, why should we pay taxes for schools? The social benefit is all of society is better because everyone is educated. We don't have to worry about people who didn't even attend 2 or 3 years of elementary school. Everybody went to middle school. Almost everybody went to high school. Society is better because society is educated. In the same way, for safety, it means that dangerous areas are removed so that no one is hurt. That health concerns are taken care of, that we kill or remove the problem with dangerous mosquitoes that create disease. Fees, on the other hand, fees are paid for government services that are specific to a particular person, to a particular user. And so the fee, the amount that the user pays, should be connected directly to the service that they use. That there should be some kind of connection between the amount they pay, the price, the fee, and the cost of the service. For example, the city has a swimming pool. If you don't like to swim, you don't go and you don't pay. Swimmers have to pay the cost of maintaining that pool and maybe part of the cost of building it. And there will be repairs sometime, and swimmers should pay for the cost of repairs. It is possible that the original construction was using general funds, but the maintenance, the operations, should certainly be part of the basis for creating the fee. In the same way, a city parking garage or a building license from the city, numerous other things that we connect with a government service, users pay, and those who don't use don't pay. Excises are something a little different. Technically, it's a tax, but in treatment, it's more like a fee. Now, here's the problem. Not all countries agree on the definition of an excise. Usually, we know it's an excise because there's a law that says it's an excise. There's a list built. Each time a new law is passed that creates an excise, we can find that. Another characteristic of excises is that they are usually based on a quantity, not a percentage or a price. It's 1 liter of gasoline. It's 1 package of cigarettes. Not, well, cigarettes cost $4, so we're going to charge 25% more, and that makes $1, and that makes total price $5. It's not based on a price consideration. It's just a fixed amount. Government says a package of cigarettes, the user charge, the excise is $1. And usually, excises are included in the basic price. When the customer goes to the store, they don't know they're paying an excise. They don't feel it's a tax that they pay in addition to the purchase price. So the cigarette box says $5. And you can't negotiate it. Nobody talks about the government fee being $1. It's $4 plus 1. No. The price of cigarettes is $5. Why? Because there's an excise. And here we can see an excise sticker, an excise seal. Okay, so in the United States, we can say that excises are indirect tax on listed items. Now, we'll talk more in about 5 minutes about direct taxes and indirect taxes. It's an indirect tax by federal, state, or local governments. That means they're not the same across the United States. Some cities have a excise on a product, other cities don't. Some states have a higher excise tax or a lower excise tax or no excise tax, for example, on automobile gasoline. These excises are collected directly from the producer or directly from the retailer. That means the consumer doesn't feel like they pay for it. The consumer isn't aware that it's part of their price. It's hidden in the price. And because customers, citizens, don't feel like they're paying a tax, maybe that's why politicians think that it's a good kind of tax. Because generally, the voters don't want taxes. No new taxes. But this way, they don't really know that they're paying for it. It gets confusing, and you've heard me say already today the word excise tax. Sometimes excises are called a tax. Sometimes a tax is called an excise. It's not very clear. So let's look at a few sample excises. In the United States today, we can find excises for tobacco, cigarettes, pipe tobacco, chewing tobacco, alcohol, that's drinking alcohol, whiskey, beer, wine, hard drinks, automobile gasoline, guns and ammunition, luxury automobiles, minerals and oils. When we pull oil out of the ground, we pull coal or diamonds out of the ground, there can be an excise. Gambling. Yes, we have legal gambling in some places in the United States, and there's often an excise on that. Even illegal drugs. Well, this one hasn't actually gone into effect, but there have been a couple of cases of states that were talking about the idea of trying to collect taxes on drugs. And one argument for marijuana becoming legal in some states is if it's legal, we can tax it, just like we do cigarettes. A couple of other interesting historic excises that are not in place today come from the UK. The stamp tax was to require people to buy a stamp, just like that cigarette stamp we saw before, to put on printed materials, newspapers, magazines, and even cards, playing cards for gambling. And maybe that's where the gambling originally got a tax, was because the playing cards had an excise. Every packet of cards had to have a stamp. The window tax. In this picture, if you can see it, helps to explain the window tax. The idea was that people who had more money had bigger houses with more windows. So we'll just make an excise. If you have 7 or less windows, you pay this much. If you have 8, 9, 10 windows, you pay this much. If you have 11 to 15 windows, you pay this much. So we had these collections, these groupings, these bands where we would say, from this number to this number, this is your price. Well, the solution for that was to conceal, to close windows, to brick them up. So in this picture, you can see in this building, 3 windows have been bricked up that we can see. We have to guess that they were bricked up, they were closed, so they wouldn't pay the tax. They were bricked up in windows or areas where maybe we didn't need the window, but clearly there were windows there, and they were closed away. Okay, a few more pointers on tax types. The word ad valorem means by the value, so it's a percentage. In my hometown in San Diego, California, there is a sales tax of 8%. So if I buy a $1 candy, I will have to pay $1.08. A specific tax is a tax per unit, like that stamp, like that excise. So if you buy a bottle of wine, there's a $2 specific tax. Doesn't matter how much the wine cost, every wine of 0.75 liter, the charge is $2. Sales tax is what you pay at the cash register when you're buying something. It's only at the end of all of the processes from the original production through any distribution. Finally, the customer buys it for end use. That's when we have a sales tax. But the GST, the goods and services tax, applies not only to things that we buy, but also services. So if you ask somebody to repair your car, they're going to charge you a tax on the parts that they used and also a tax on the work, the labor, the man's time, the woman's time. So goods and services, not just goods. VAT, people who travel are very aware of VAT. VAT, value added tax. This gets added each time. Each time the product is changed, each time there's some improvement, there's a tax. So iron comes out of the ground, it gets converted to steel. The steel is sold to the automobile maker who makes parts. Those parts are sold to the automobile company that assembles them to build a car. That car is then sold to the retailer who sells it to the customer. Every person along the line pays a tax for the amount of increase of value, VAT, value added tax. Okay, now we come to what is perhaps one of the most confused items. It's actually very simple, but I hear lots of different understandings. We're talking about the collection of money, or how does money go from the citizen to the government? And direct collection or direct tax means the citizen pays to the government. And an indirect collection is where the citizen pays the tax through someone else, through an intermediary. The picture is quite clear. Citizen pays to government, or citizen pays to somebody who then pays to government. Well, why would we have this dual system? Direct payment seems like there's a really nice way of handling things, but in fact, there's some advantages and some disadvantages to indirect collections. Indirect collections have some advantages, such as we usually design it so that the poor don't have to pay, and they don't have to do government work. Indirect taxes are actually quite convenient for the average citizen. And they're actually quite convenient for the government because we don't have so many things to worry about. We can cluster these payments. We don't have to worry about, did Mr. A pay, did Mr. B pay, did Mr. C pay? We work with a smaller group of organizations. We work with stores. Indirect collections can be spread across quite a number of things. All the things that you buy in stores, all the things that businesses buy, all the things that you buy outside of stores, like a ticket on a bus. We can put taxes on all kinds of things. And it's quite easy to collect. When you pay for your $1 candy and you pay an extra 7 or 8 cents or whatever the tax rate is, it all happens at one time. We say that indirect collections are elastic in yield. What that means is the more things are bought, the more taxes are collected. When the economy is slower, people don't have as much money, or people choose to not spend, then the yield, the amount of money that comes in, will be lower. So it's elastic, it stretches. Many people think indirect collections are equitable. That one can be very much argued. But again, if you don't have much money, you just don't buy, perhaps that's equitable. And we can use indirect collections to curb consumption. That is, if there's something we don't want you to use, we increase the tax on it. Whereas a direct collection of a general item doesn't really modify people's behavior. But what are the problems of indirect collections? Well, people could say that it's not equitable because everybody needs to buy food. Everybody needs to buy gasoline for their car or ride a bus which uses gasoline. And the rich people can afford it easily and the poor people cannot. So maybe it's not equitable. We could say that an indirect collection disadvantages industry if industry has to pay for the raw products. So you can see that there might be times when we want to charge a tax or an excise, and sometimes when we might not. There's an argument that indirect collections are uneconomical because we have more steps. There's an argument that indirect collections, because people don't realize so much that they're paying, it's just part of the price. Ultimately, they paid it. They go to the store, they paid $1, it's $1.07, they forget it. The money's gone. But when you do a direct collection, people are thinking about, well, I'm giving money to the government, so what is the government giving to me? People think more about society and government and how things are supposed to work. That's an argument. And as we said, indirect collections can be uneconomical. Well, they can be difficult to track, and that's kind of related. That's a lot of talk about the advantages and disadvantages of collections, and almost every point, almost every argument, someone could argue the opposite way. So what are some direct taxes? Well, income tax. At the end of the year, you fill out some paperwork, you identify how much money you're supposed to pay, and you pay it. Now, we know that, or those of us who work, we know that our employer takes money out of our paycheck each time. That's called a withholding. They are holding money from us, and they send it to the government for us to make sure that it gets paid. But at the end of the year, each citizen, each resident is responsible for filing the paperwork and turning in the paperwork and making sure that they paid enough, and if they didn't pay enough, to pay more. And if they paid too much, they'll get some back. So they are communicating directly with government. It's a direct tax. There's nobody in the middle who's taking our tax. Our employer is merely holding it for us. Similar to income tax is corporation tax. It's really pretty much the same idea. Instead of one person or one small business, it's the corporation. Property tax. You own a house. It has value. Every year, the government wants you to pay something. And from that property tax, the government will improve the sidewalks, improve the roads, improve the schools. Property tax is the number one resource, the number one revenue for most local governments around the world. Motor vehicle registration is a direct tax. Now, that's not the initial buy the car and pay a sales tax and probably pay the registration at the same time because it's convenient. But after that first time, each year when you register your car, you get a new sticker for the license plate. That registration you file directly with government. And so that is your motor vehicle registration. Similarly, inheritance tax. When someone dies and you receive money from that person, you're going to pay a tax. That inheritance tax you file with the government and you pay. A gift tax, very similar to an inheritance tax. Somebody gives you a large gift, you pay a tax on it. A wealth tax is a little bit different. Here, because you have a lot of wealth, It's not income. It's not coming in now, but you have it. You've had it for years. There's a wealth tax in many countries. And you file on an annual basis, and it's the same thing. Municipal residency tax is kind of a property tax. Because you live in that town, you're a living, breathing person, there is some kind of tax that you should pay. And what are some indirect taxes? Well, we've mentioned some of these before. A sales tax, you pay to the store. A value-added tax, you pay along the line, whoever you're buying from, you give them the money and they turn it into the government. A goods and services tax, in the restaurant, at the service shop, in the store, goods and services combined. An excise, like that sticker on those cigarettes. A customs duty, when you enter the country or when you buy something overseas and it's shipped in, they may charge you something like a sales tax. A service tax, well, goods and services, okay, service tax. If you buy stocks, the time that you buy a stock and sell a stock, those securities, those exchange of securities, there is a transaction tax. So, we're looking at some excise seals on some bottles of beer, big bottles of beer. What do you think? Direct tax? Indirect tax? Fee? Excise? Have you got it? This would be an excise collected indirectly. Now, there might also be a sales tax on that bottle of beer, but that seal was paid by the beer bottler. They probably bought 10,000 excise seals. Every bottle gets one seal, so that's 10,000 bottles of beer. Next week, they'll have to buy another 10,000 seals. Something like that. Okay. Now for the biggies. These are the big ones. These are very often confused, and they're really not difficult. And we've got some pictures that will help to explain it. But we start with the words. Progressive, progress. Regressive, to regress, to go back. Proportional, which sounds like balance. And digressive. Di is like B. Sounds like something like two. Bicycle. Progressive taxes are based on a progressive or increasing tax rate schedule. Technical word, right? Schedule means a chart. Simply, the theory is the more you earn, the higher your tax rate. If you're poor, the percent that you pay will be very low. And as you make more money, you have more free money, money you can spend for any purpose. You can spend that money for government. Your tax rate is higher. Regressive rates are the opposite. They have a greater impact. They affect the low-income individuals more than the high-income earners. So in this case, the low-income people feel like they're paying more. And in fact, in some ways, they are. Proportional taxes are sometimes called a flat tax. The idea is that the effect is the same for low-income people, middle-income people, high-income people. It's roughly equal. And then a digressive tax, most people don't talk about it. It's kind of a flatter version of a progressive tax. It stops climbing earlier. Maybe it starts off at a higher rate. Let's look at some pictures. It'll help explain. Okay, so we start with an empty chart. And on the bottom, running from left to right, we see income. So the very left would be a zero income, and the very right might be $10 million in a year or something like that. Incredible amount of income, incredible amount of pay. And the left side, going from bottom to top, is the tax rate. Now, we usually call it a marginal rate, and we'll talk about marginal in a moment. But for now, just think of it as from lower tax percentage to higher tax percentage. We start with regressive because it's the one people are most concerned about. And what we can see is in the regressive chart, people who have less income, farther to the left, are paying a higher rate of tax in a percentage. And as the income increases, the amount of tax decreases until we reach a point of zero or very, very low number, and then it doesn't change anymore. Now, does this really exist? Certainly not anything as dramatic as this picture. But it gives the explanation of how people can say that something is affecting them more. And we'll talk about some examples in a few moments. Let's compare that to the progressive tax. And as we can see, a progressive tax starts with a low percentage for low-income people, and it climbs to some point, depending on how much income you have, and then after you reach this certain point, maybe it is $1 million each year, the tax does not increase anymore. Now there's two lines, a blue line and a green line, and the difference is just to say that sometimes a progressive tax rate starts with zero tax until you make a certain amount of money. So let's say if you make less than $1,000 in a year, you have zero tax. And then if you make $2,000 in a year, your tax is very, very low. And if you make $10,000 in a year, your tax is higher. And if you make $50,000 in a year, your tax is higher. And if you make $150,000 in a year, your tax is higher. Okay. The other version of the progressive is the blue rate that says that even if you have no income, your tax is still a low amount, maybe 3%. And as you earn more money, your tax rate goes higher. So really it says, for this progressive rate, where do we start? And now we add the other two. Proportional is pretty easy. That gray line, it just says what it is. The tax is the same. It doesn't matter how much money you make. If you're on the left, low income. If you're on the right, very high income. Everybody has the same tax. And finally, the digressive, which is kind of an orangey brown, simply shows that the tax rate starts higher than either of the progressive rates, but it stops climbing before either of the progressive rates. So digressive is a modified progressive. Okay, it's a little bit more balanced. How do we apply these tax designs? How do we use them? Well, a progressive tax, or maybe a digressive tax, is commonly income tax. And we'll talk about those in a couple of minutes. A regressive tax, in reality, on paper, there probably isn't one. But in practice, people usually think of the sin taxes. Sin for Christians, what you should not do. Cigarettes are bad for you. Alcohol is bad for you. So there's a tax. And they're usually a fixed tax. Technically, maybe it is a proportional tax in that it doesn't matter how much money you earn, you pay the same tax. But in practice, poorer people, richer people, if they drink the same amount of alcohol, they pay the same amount of tax, but the effect on people is much different. Poor people feel like they're spending a lot of their money on tax. Proportional tax is designed so that people who have more money, people who have less money, doesn't matter, they all pay the same tax, like that 8% for a sales tax. In fact, the regressive tax and the proportional tax are kind of the same. That there's the theory that says one package of cigarettes or $1 worth of candy or anything, they're all the same rate. But in practice, generally a sales tax, again, is going to affect the poorer people more, even if the richer people are paying more. The richer people feel they can pay for it. So what happens is that governments describe their tax systems, they explain them, they write the rules and they write the charts according to marginal tax rates. And that's coming in just a moment. But citizens don't look at those marginal tax rates as much. Citizens consider taxes to be fair or unfair, not because of the paperwork, but because of how it affects their life. Sales tax is often based not on all sales, but on certain sales. So for example, a box of milk will usually not have a tax because milk is healthy. We need milk. If you're rich or you're poor, you need milk. So we're not going to tax that. But something else is a little bit more free to choose. So candy maybe is taxed. Marginal versus effective rates. Marginal rates are talking about groups of amounts that are climbing 0 to 10, 11 to 20, 21 to 30, 31 to 40. Okay? If you are at 38, you don't pay 38. You pay 0 to 10 plus 10 to 20 plus 20 to 30 plus 30 to 38. So you're paying in those bands or groups, brackets. Effective rates are the actual amount after we put it all together. We figure out that 0 to 10, 10 to 20, 20 to 30, 30 to 38, and we subtract any discounts. Maybe you have some legal deduction or there's some waiver. We do all that. We calculate the final number compared to the actual income or the actual value. So if you made $38,000 last year, you're not paying from 0 to 38. You're paying 0 to 10, 11 to 20, 21 to 30, 30 to 38. What are all those numbers? Minus everything. Compare that number. Okay? It's an effective rate, an actual amount. And it makes more sense when we look at some examples. So the marginal tax rate is the percentage tax, the 7%, 18%, 39%. The percentage of tax applied to you for each tax bracket. And we'll see those in 30 seconds. The effective tax is the final calculation. Okay, so let's look at an example working with marginal taxes. On the left, we can see the marginal tax rates for the year 2016. For those who are in the lower income, those who earned from 0 to $9,275, their tax rate is 10%. The second bracket is the 15% bracket. That bracket is for the income between $9,275 and $37,650. And so on and so on. Let's see how it works with Mr. John Smith. John Smith earned $120,000 income. The first $9,275 are taxed at that lowest 10% rate. So the tax on his initial earnings is $927.50. But he earned more. So all of his income that falls between $9,275 and $37,650 is taxed at 15%. So for that part of his income, his tax liability is $4,256.25. But he made more. So all of his income that falls between that $37,650 and $91,150, that part of his total income is taxed at 25%. So his tax liability for his income in that marginal tax bracket at 25% is $13,375. Finally, he earned $120,000. So the amount of his income between $91,150 and his total of $120,000 is taxed at the 28% bracket. That comes up to $8,078. So his total tax obligation, adding all those numbers up, is $26,636.75. Wow, that's a lot of tax. The effective tax. Don't worry about those marginal tax rates of 10%, 15%, 25%, 28%. The effective tax is his total tax divided by $120,000. But was he married? If he's married and his wife is not working, he has a deduction. He can reduce his tax liability. If he has children, he can reduce his tax liability. If he owns a home and he's still paying for it, he probably has a loan. He is paying interest on that loan. The interest on the loan is tax deductible. If he had serious health expenses, who stayed in the hospital, then those health expenses can be a tax deduction. And there's lots of other legal loopholes. So let's look at another marginal tax example, example number 2, as a way to compare. Case 1 was John Smith. That's on the left here. Nothing has changed. Case 2 is James Jones. He earned a little bit less. He made $90,000 last year. So in the 10% bracket, it's the same. From 0 to $9,275 is taxed at 10%. The second tax bracket, James Jones, is the same as John Smith. The earnings between $9,275 and $37,650 is taxed at 15%. $4,256.25. In the third tax bracket, there's a little bit different. Remember, the third tax bracket, the 25% bracket, ranges for all the money from $37,650 up to and including $91,150. But James Jones didn't earn quite that much. He earned only $90,000. So his 25% tax is on the amount of money between $37,650 and $90,000, which is what, $52,350 times 25% comes up to $13,087.50. James Jones did not have any earning falling into the 28% bracket, or the 33% bracket, or the 35% bracket, or the 36% bracket. So James Jones' total tax obligation was $18,541.25. And his tax obligation is less than John Smith because he earned less than John Smith. We saw Joe Smith's initial compiled tax rate, 22.2%. John Jones' initial compiled tax rate is 20.6%. But remember, deductions can reduce your taxable income. And as it happens, the rich usually have more deductions. And this can create some misunderstandings or some misinterpretations. The first problem is that we actually pay many kinds of taxes. And the typical worker often has 6 or 7 different kinds of government money coming out of that regular paycheck. There might be an unemployment insurance and a disability insurance, some kind of a government-required pension, federal income tax, state income tax, other kinds of taxes. So income tax is only one of these. Second misunderstanding in taxes is that tax structure isn't based on a lifestyle, or it's based on what is imagined to be a typical lifestyle. So for example, one person smokes cigarettes and one person doesn't, it's going to change your view on taxes. And the third thing is these tax loopholes. We call them loopholes, a loop in a rope, which cause deductions and exemptions that can be very surprising. And a good example in the last few years have been the cases of Warren Buffett and Donald Trump. Let's take a look at cigarettes and cigarette taxes. Just to make our math easy, let's say a package of cigarettes cost $5. And the smoker that we're thinking about buys 2 packs of cigarettes each week. Smoker number 1 is Bob White. He's a working class man. He's actually a little bit low on the income level. He makes $1,000 per month. 2 packs in a week is $10 a week. If there's 4 weeks in a month, he's paying $40 for cigarettes. That's 4% of his monthly income. Now remember, cigarettes have a fixed rate. It's an excise, so that tax is pretty strict. Smoker number 2, Bill Green, makes $4,000 a month. He also smokes 2 packs a week. He pays $10 a week for his cigarettes. He pays $40 in a month for cigarettes. But because he makes $4,000 a month, he's only spending 1% of his monthly income on cigarettes. Of course, Bob White feels that any taxes on cigarettes affect him much more. For example, if it was $1 per package. So, even though the tax is exactly the same for every person, which theoretically is a proportional tax, in reality, the effective tax is quite regressive. Wealthy people are spending less of their income on cigarettes than the working class, the poorer, the lesser income. Because of all the loopholes and deductions and withholdings and special rules on income tax, there came a case a few years ago where Warren Buffett, one of the richest men in the world, pointed out that his secretary paid more taxes than he did. How can that be? A man who's making millions of dollars every year versus a secretary who's earning tens of thousands of dollars. 1% maybe income compared to the boss. Another case example, Donald Trump had a $916 million tax write-off one year, which he could carry forward. In other words, that deduction would be good in future years. And so, for many years, he paid no taxes. But Donald Trump is recognized as being very wealthy. Because of these kinds of situations, President Barack Obama proposed something that is called the Buffett Rule, named for Warren Buffett. And this is a kind of a flat tax, or maybe a ceiling on the regressive tax. And it says people who earn more than $1 million in a year must pay 30% minimum tax, that they can't have deductions to get them below that rate. That rule is not in effect. It's a proposal. And it might be years before it comes into effect, if it ever does. But it's an example of how many people feel that regressive rates are completely out of control and they're sliding down to the lowest number, causing working class people to pay more tax than the wealthy. Another thing to look at, usually this is based on specific fees at public organizations or many NGOs, is what's called a sliding fee or a sliding fee scale. Okay, a scale is a chart, it's a way of measuring. And it comes to the question, is it really fair to charge everyone the same when people have different amounts of income, when people have different assets? Well, many people think it's not fair. In the same way, should the fee be the same regardless of the family? If one person has 5 kids to take care of with their income and one person has no kids, is their income or are their assets really the same? Maybe not. How about other assets, other valuables? For example, money in the bank. Somebody, their income is low, they're not working, but they have so much money in the bank. Or one person owns their own house and another person doesn't. Are they the same or are they different? Or when we start going down towards the lowest levels of money, of assets, of income, the question of whether somebody has a car or doesn't have a car, that might be something to think about. The person who doesn't have a car and must ride the bus, should they pay the same price as somebody who has a car? An old car, a new car, these can be different questions. And there's many other things we could look at when we consider, should everybody pay the same fee for the same service? So let's look at a couple of fee charts. Here's one from an NGO. And it's very, very simple. On the left, we look at how much income in a household. It's very simple. From the bottom, people who have no income to $15,000 per year, net income. What is net? Net means after we adjust some things. Maybe after we subtract the cost of a house, maybe after we subtract the number of children. Net means after adjustment. Gross means the total. Net means we make some changes, we subtract some things. So 0 to 15,000, $15,000 to 25,000 is the second tier, the second level. We could think of it as a bracket. 25,000 to 33,000 is the third tier, and we see that it climbs. And so we have different services. We have community acupuncture and herbal consultations. We have a 2-hour workshop, a 3-hour workshop, and a 4-hour workshop. And as we see, as you go up the chart with higher income, the fee, the rate that you must pay for that service goes up. Okay, A second chart is a little bit different design, but it does the same thing. In this case, we talk about size of the family as an important consideration. Now, the blank spaces means that there's more of the same. Whichever number you're on, it's more of the same. This chart is flipped. It's reversed. So the lowest income is at the top of the chart. So if your annual, year-long gross income, no net, no adjustments, if your total household income is less than $8,625, you will pay 0% fee. It's free. And of course, if you have 1 person, 2 person, 3 person, 17 persons living in your house, it's still free because you're in that area of 0. If your income is, let's say, $30,000, we have to go down the chart on the left, more than 0, more than 8,000, more than 19,000, more than 29,000. We're at 30,000, so that will be the row 29,426 to 39,825. Okay, on that row, there's 2 people in our house, so 29,426 and more. Slide to the right, 2 people in the household. Our fees rate is 40%. Whatever the total price is for the fee, we pay only 40%. We don't have to pay 100%, we pay only 40%. And the same way to work the chart. However much money is in the household, find it on the left columns, slide to the right depending on how many people are in the family, find your rate. We've done everything we're going to talk about today. But for now, let's take a quiz. Thank you very much.